Hey guys, we're back. I'm doing the $5 a day challenge, and well, mine's a little bit more, not much, but instead of like, I think I'm doing $37 a week. So $2 more than $5 a day. But this guy, he's already done this for almost 2 years now. Um, and it looks like he's up to almost 8 shares of VOO, which is today trading at $410 a share, but his average cost is $378, and the market value is $3,000. So uh, a little $5 a day adds up over time. I was just looking. He's got a margin account. Looks like. Um, But what I wanted to focus on was this, compound interest calculator where he shows that initial deposit, he's doing $35 a week, so that's, I guess, $152 a month. And he puts in 10.5% return, which I think is a little. Yeah, that's what the historical return is, but that doesn't mean that that's what the future is going to be. The If you buy the S&P 500 today, my opinion is it's a negative return or a very modest return. It definitely wouldn't be 10% or 10.5%. Why is that? Why do you think that? Well, because I think the market will fall 50, 60, 70, 80, 90% sometime in the near future. I don't know. I've been saying this now for couple years, but the problem is I still got to invest. I still want to keep investing, even though there's a high probability that the market will crash at some point. But yeah, just $5 a day, and it into 20 years is $124,000. That's crazy, guys. That is basically what the 65-year-old today in America has to retire on. It's really sad that they were so worried about their new car or new four-wheeler or going on their trips and whatever, that they couldn't take a minute to save $5 a day. And the beautiful part is, the total principal, the hard-earned dollars that you invest is only 35,000, and the interest, the money you didn't have to work for, is 75,000. So basically, 2/3 of that money is just interest, compounding on interest, on interest, on compounding, and so it's beautiful to see. I know it's not probably cool to watch or fun to watch. Slow. It's not fun to watch paint dry, basically, and that's kind of what investing starts out with. You're watching paint dry, and you're investing for years and years and years, and you see very little happening, but then you start going over 100,000, and you start seeing the exponential compounding machine at work. But yeah, I just wanted to. This guy's name's Bob Sharp. Let me give him a like while I'm at it. I was already a subscriber. Um, you know, uh, just to show you what my count might be if I can continue the $5 a day thing for a couple years. And who would have thought like your screw around account might be worth more than most people's retirement funds? And we're not even talking 40, 50 years out. We're talking just 20 years. I mean, um, even small amounts of money, guys, can grow into huge amounts of money. And one thing that I learned about Buffett when I used to read some of his books or whatever, some of his commentary was, when he goes to get a haircut, he doesn't think about today, all right, I'm spending $5 for a haircut. He thinks about, I'm not really spending $5 today. What I'm doing is I'm giving up $50,000 compounded, at whatever the interest rate is over how many years. Like, and that is the reason why he is so frugal. Probably one of the most frugal billionaires you'd ever meet. Just to add that, most of the millionaires in this country, probably 60% of them, are couponers. And you wouldn't think that, oh well, a millionaire doesn't need coupons, but they became millionaires because they were frugal, because they had these good habits where they were saving money. They used coupons. They were tight with their money. When they go to the grocery store, they write a list so that they have a purpose. They have everything budgeted. They have everything planned out. They set goals for themselves, and they plan for the future, and have a plan to meet those goals. But yeah, this is what a little rinky-dink $5 account can accomplish in 20 years. Um, and I'd like to see what it would be in 30. Let me see. Let's look at it ourselves. Now I don't want to use this 10.5. Let's use 10 because we're good. We're good investors. We're smart guys. We're really gonna get 10. But after 40 years, $235,000, a quarter of a million bucks. As you can see, the amount we put in was only 17,000 something, and interest is over 200,000 in interest. That's crazy, guys. And you can see like the it's not really until you get over 100,000 that things start really. That's why Munger says get your ass to 100,000 as quickly as possible, and then because once you get past 100,000, things start taking off. The first few years, things are painful. You don't see much happening. You thinking about giving up. Maybe there was a market crash. Maybe you're losing. You're down overall. Man, I've been investing for 5 years, and now the market crashed and I lost everything. Shut up and just keep investing. And eventually, you got a $250,000 just off $5 a day. And yeah, it might be hard for someone making minimum wage to say $5 a day. It might be, that might be 15% of their income, but before taxes. But I think it might even be possible for someone making minimum wage to do this. So Maybe if they were living with their mom and dad, didn't have to pay rent. Maybe if they were walking to work. But yeah, just $5 a day, guys. In 40 years, that's like 18 to 65, something like that. $250,000. Not bad, not bad at all. But since we're not just average, guys. We're above average. So, what if you do 20% compounded? Look at this. Look at this thing. Look how beautiful that is. $6 million off $5 a day. Who'd have thunk it? What if you're one of the truly best investors in the world, and you can compound at 30%, like that guy in India he just had bought two companies that were 3% of his portfolio, and over the next 20 years they had grown to be over 50 or 60% of his portfolio. And that guy in India who died at 65 that had $4 billion. B with a beef. B for billions. No, we're not talking millions, guys. We're talking billions now. But look at just a little $5 a day. If you can compound at 30%, $213 million. Ain't that amazing? And all you put in there was 17,000. But your little 17,000 compounded to $213 million. This is truly exciting, guys. This is what, and if you want to get crazy, we're talking billions. You could be that next India guy that bought those two companies that were 3% of their portfolio. They held for 20 years and they became billionaires. Now, you want to really get crazy? Let's look at 50%. What would 50% be? You'd probably be the richest guy in the world, probably. $250 billion at $5 a day. Who would have thought it? Is it possible? Yeah. Is it likely? No, but just imagine, guys. If you can, but a lot of the stocks we looked at, looked at even U.S. Steel. I told you I messed up and sold that one a couple weeks early, but it was $20. Now it's $30. That's a 50% return. You do that one time a year. Hey, you're here. This is you. If you do, like I said, the U.S. Steel was $20. It was trading at a PE of 2. Now it's closer to a PE of 5 times earnings. The price to earnings ratio, it jumped from $20 to $30 on news of a bidding war to acquire the business. It's a very old business, and there might be a lot of hidden gems inside of that business that we don't even know about. Like, for example, when I was talking about Sears before, where the Sears was a 100-year-old company, where they might have bought the real estate at $50 or $100 an acre, and then next thing you know, fast forward 100 years, and that that land you own is no longer worth $100. It might be worth $1 million. So it's possible that U.S. Steel has some of these hidden gems, these hidden assets that are hidden inside their balance sheet somewhere, where they might have bought the land or bought the facility for something, and they're not putting what the value today is on the balance sheet. They're putting the the price they paid back 100 years ago on there. So so yeah, I mean, you just do nothing all year long. You find one trade you like, you get a 50% return, and you just sit back, relax, and do it again next year. Do it, you know. So really, to do that 40 times, it's possible. I mean, yeah, I mean, if you're wrong on something, that could kind of screw that up, or you take a loss. But in theory, if you just had one stock and every year you just got 50% return on that one trade that you like, you do it 40 times, do it one time a year, you make one trade a year, you get 50% return on your money, and it's possible. But like I said, there's been very few guys. I'd be happy if I could, over my course of an investing career, could get 20 or 30%. I'd be very happy with that. Um, I don't want to get average. I think probably if you just buy the S&P 500, this is probably more realistic. Maybe a 5% return. Um, but yeah, it's fun to play with the numbers, and um, the way that you can retire early faster is, if you don't want to work for 40 years, you want to retire in 20, you have to get a better return. And the way you do that is by value investing, or maybe you just get lucky. And maybe you just stuck all your money in Tesla, just got lucky and bought the one unicorn that everyone in the world is too stupid to realize that is overvalued, and just keeps paying more and more and buying it for an exorbitant amount of money. But with value investing, a lot of times, like, it's not like a question of whether or not I think something is worth more, or whether or not something is undervalued. The only question really is how long is it going to take for all the technical trader idiots to realize that this thing is undervalued and buy it, or some bigger, larger company to eat it. And it's almost, the analogy I like to think of is like a fish. You got a small little tadpole in the ocean, or maybe tadpoles don't live in the ocean. I don't know, but a small little fish, and then you got a bigger fish comes and eats it. That's the same thing with businesses. You'll have that's the reason Apple has not had really any competitors. Anyone that's ever risen up to challenge them, they have just gobbled them up. And years ago, when the U.S. They would break up monopolies. If they had a monopoly, they would break that company up into, the U.S. Oil, or whatever the original name was. They broke it up into 7 or 8 different oil companies. And ExxonMobil merged eventually, but they were separate. Chevron, all these, BP, all these were part of that pie. And even today, we're, the phone companies. I don't know what the name was. Maybe it was Bell or something like that. But Verizon, AT&T, all these were part of that the government forced them to split up. Because they were a monopoly. And we have not seen that with the big tech companies. And today it's more of a worldwide economy, and I don't think that we have the political clout to stand up uh, to them, and not only that, but it might hurt us in the long run, where we are now competing, globally with other companies around the world. So even though there may not be a direct competitor in the U.S., there might be a direct competitor, say in China, for example. Um, anyway, thanks for watching, guys. Bye.